So in this video, we talk about the one of the technical analysis tools called Bollinger Bands. And, so far we talked about the moving averages and, why the technical analysis is such a big phenomenon. And Bollinger Bands is a simple, very popular, and it's actually very easy to do and very easy to interpret. And so I think you're going to like the Bollinger Band. So the idea is actually very simple. Let's include, this is S&P 500 SPX on the screen that you see. I'm using TradingView. It's free and it's actually a fantastic website. So um, I'm just going to include a very simple moving average and simple moving average. And let's begin our discussion from that. And what I want to do is I want to have this moving average, say about 50 days, shorter term, and based on the close of the day. So, and let's include another one, perhaps the moving average for the 200 day. And let's make that one a red. The idea is that with a 200 day, you actually catch the longer term perspective of the market or longer term, what people consider to be their usual, and with a 50 day, consider or you catch what people consider to be short term, their normal. So, the whole idea behind, the moving averages is the reversion to the mean. And it actually comes from economic theory that, data series have that tendency to revert to their mean. And we do see that volatility around that mean. The 200 day, for instance, right now, the S&P 500 is or was significantly above that 200 day average, which is the long term investors' perspective in a way, what we consider to be our normal for those past 200 days that moves on. And notice how recently we actually reverted to the mean. So it's actually quite fitting that, we actually see this movement and volatility around these moving averages. And, we are basically looking at investor behavior when we are talking about the moving averages and reversion to the mean. So, we talked about how investors' behavior change when they consider things out of their norm. Meaning, if you're looking at a rubber band, how much elasticity do you have to move around that? Again, what we consider to be the norm. So if you're looking at a 200 day, which, is the longer term moving average, and notice how high you are from that 200 day. So for a lot of people who are thinking about, investing or who are thinking about trading, they might actually consider market to be significantly higher than what, they feel more comfortable with for the past, given, what happened in the past 200 days. So this overextension, makes people a bit uncomfortable to invest or to trade. Very similarly, if you go to a different time period and you see how the price is now significantly lower compared to the 200 day again, and that again is perhaps considered to be an oversold market, but again, a bit out of their comfort zone, and then therefore investors and or traders might actually feel uncomfortable trading at these levels. And notice the 50 day has a little bit less of a volatility or less of an extension or mean diversion from that area. So the 200 day seems to have a little bit more diversion, a little bit more extension out of that comfort zone, but a 50 day has a little bit less. So shorter time period usually has that tendency of having the markets either revert or divert with shorter time spent. So how much of so let me actually take the 200 day off. how much of an extension is an overextension? How much of a diversion is would make us uncomfortable? So, like for instance, if you look at this 50-day, notice how we were significantly higher, and then we actually reverted back to that mean, and then around that mean we oscillated a little bit, and then we actually oversold. Then we came back again to revert to the mean, and now we're again significantly lower than that mean. So that mean reversion is quite evident, and but again, it's a chicken and egg situation. Does the prices come revert to the mean because people feel uncomfortable with those diversions, or I mean, you are basically calculating a mathematical average, a moving average of prices, and therefore um, does the mean catch up with the prices? Because as you can see, the mean is not constant. The mean changes all the time. The moving average changes all the time. So, chicken or egg, does the prices catch up with the mean or the mean catch up with the prices, or maybe a little of both? That it just, we have this tendency of price and the mean converging at a certain level. But obviously, I think in my own personal opinion, I think the main issue with technical analysis is to find a sweet spot where, you would consider investors to be uncomfortable with that much of an extension or that much of an extension or a diversion from that mean. And I think that most of the time it's not about being divergent, but it is about how fast you become divergent and how fast and how sustainable you are off that divergent level. So in that respect, this is what the Bollinger Bands look. Basically, it gives you an average, and then it basically draws you an upper range and a lower range within which you would expect a normal, or something resembling a normal trading behavior. And anytime it breaks beyond those levels, then we don't really talk about that normal behavior. So let's draw the Bollinger Band, and you'll see what I'm talking about. So and you see, it was very easy. Let me do that again. All I'm really doing is I'm clicking on the indicators, and I typed in Bollinger and just Boll, and then Bollinger Bends, and then there you go, you have it. But I want to change a couple of things. Number one, actually, I want to change only one thing. So the Bollinger bends draw the bend based on how much volatility is acceptable to, or in your opinion, how much volatility is acceptable to investors and traders. But volatility from what? See, that's the thing. So if you click on settings, you can actually look at the length. That's the moving average, right? So in fact, you can actually go with any type of moving average that you want, but I want to keep it to the simple. And I want to actually draw 50 days simply because we were talking about 50-day moving average. And then the volatility level that you personally impose as your normal. And there is no set rule that says it has to be 2 standard deviations or 1 or 3, but it's mostly common. It's mostly 2. And again, as we discussed previously, the technical analysis is all about self-fulfilling prophecies. If you have more people believing that 2 standard deviation is the perhaps more comfort zone for more people, then it will be so. But if you feel that 2 standard deviation is too high, obviously you can change it to anything you want. So now that we're looking at 2 standard deviations in a 50-day, notice how our range actually expanded a little bit. And all really we are looking for now is times at which prices breach above or below those bends. So like for instance, right here, you actually see how the price actually breached about the upper bend, and it had actually corrected itself. However, I want to say Just because the price actually broke above that range does not mean that it will be immediately correcting itself. In fact, notice right here for this a daily chart. So once it broke 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days straight, it actually stayed above that range. And then it corrected itself just for a few days, and then it actually came back up again. And notice it's just the price overall is really not declining. In fact, it continues to go up. So if you believe that the technical analysis is so correct and that anytime the price breaches above or below, you have a signal and therefore you robotically trade, or you may be mistaken with that. If it was so easy, everybody would do it and everybody would be billionaires now, wouldn't they? So the idea is that if it is above that range, it usually means that people are uncomfortable with that level and they may refer to it as overbought. Overbought does not mean that it will correct itself. It just means that it may be a little bit harder to continue going up versus, it just straight up. So, like I said before, if the prices are increasing, and increasing too fast, too high, it makes people a little bit nervous. Like, to buy more at these high prices. Am I buying it too high? Is it too? Maybe I should wait a little while. And that uncomfort zone, if you will, makes it harder for these prices to continue going up at the same pace. Notice, and then there will always be some people who will think that this is too high and therefore let's take profits and get out. And notice how, the price actually retraced a little bit and then continued going up, but it just took time. See, this happened in mid-June and all the way to the August, will continue going up, but we actually had setbacks just for a few days. And then, we overextended a little bit. Notice again, in the meantime, the average is also increasing. So it's not like the Bollinger Band is a constant bend. When the price actually moves above that band or below that band, there's a signal. But notice it's all about how much or how many days of the moving average you pick. And we actually went with 50 days, and the price actually is above that. And we simply refer to it as overbought. And, in my opinion, I would probably call this is just, it's probably harder to continue going up, and perhaps it may be easier to come down. And but again, it's not written on stone. Notice the oscillation around the mean again as the 50-day, and then we actually overextend downside. And notice for multiple days in a row, the price just keeps going down, and below that, um, you know, lower band. And because we are actually breaching that lower band, some people may refer to it as a trigger to buy. But notice how it actually came back up and then came back down again. So I would probably refer to this as oversold, and that it will be easier to, probably go up a little bit than continue going down with the same pace. So the Bollinger Band, in short, gives you a moving average. It's based on the moving average, and it gives you a range within which, uh, you know, people or investors and traders may feel comfortable trading. And anytime you actually break those bands, you will be either overbought or oversold, and that makes people uncomfortable. And that doesn't mean that it's a trigger to buy or sell in any way. It's just the market's overextension. And again, remember, you actually made up all these variables as to how many days, what standard deviation. In fact, let me show you. Just because you actually draw this way, and we actually have these overbought and oversold regions, that doesn't mean actually so. In fact, if I were to go with, say, 3 standard deviations, notice how the range is going to expand, and all of a sudden I don't have a breach anymore. So keep in mind that technical analysis is based on the parameters or variables that you set. And based on those parameters, the technical analysis will simply fit the data and show you what it is. And I don't think that it is possible to use technical analysis to create robotic trading rules that make money for you without much risk. It's simply not can't happen. But like I said, our job as financial analysts is to come up with reasonable explanations and perhaps help with our decision making. In that sense, Bollinger Bands gives us a markets behavior, investors and traders behavior, and how they might actually feel, especially when we would refer to this as oversold regions, oversold time periods, overbought time periods, and oversold time periods, and nothing more than that. So, and um, and that's about it. So let's take a look at a few. This is again S&P 500, but the ETF. So this is pretty much the same. So if you look at say Apple, notice how we just kept continuing to go up. It just, Bollinger Bands or not, it just kept going up, and there is no mean reversion at all. I mean, it just priced for almost half a year, just kept going up. And it was overextended, yes. It was overbought, yes, but it just kept going up. Um, let's for Disney. So if you look at Disney, it will be just the opposite. Now, no matter what happened, there's not much of a change. And just even though you're oversold, continue going down. Even though you're oversold, continue going down. So there is no, definitive. If it is overbought, It's a trigger. It really is not. Um, so let's take a look at say JP Morgan Chase, and notice now that there's a lot more oscillation with JP Morgan Chase, and by the way, notice how the standard deviation actually narrows and widens during certain times, and it's based on standard deviation of closing prices. So if the standard deviation, if these candles get big, as you can see right here, then you have a huge margin, and therefore your standard deviation is quite wide. It's two standard deviations each side. So as you see, as these candles get bigger, you actually have a huge wide area. But as the candles get smaller, notice how you have a neck. And then as you have a little bit bigger, candles with more movement, volatility, then you expand again. So, the Bollinger Bands, like I said, it's not a straight line. It actually constricts and widens, and based on the volatility of prices from one day to the other, based on the size of the candles intraday, and based on that, you basically are trying to figure out the market's perspective as to if the prices are overbought and oversold. And it just because they're overbought does not mean that it will correct itself. Just because they're oversold does not mean that they're going to correct themselves. The moving average moves with the prices. It's usually when the prices move too fast, then there will be some dampening on it, perhaps. And if the prices move down too fast, then there might be people who are, uh, you know, trying to buy the dip, if you will. But again, these are all speculation, and our job again is to make comments about the state of the price compared to the averages, compared to or based on investor behavior. So that's the Bollinger Band, and thank you for working with me. And if you have any questions, please do let me know. Thank you. Bye now.